Hey everyone, on today's video, it will be all about how we invest as entrepreneurs. We get a lot of people asking, where we invest our money. A lot of people are curious what we do. Is it all invested in our own businesses? Do we invest all in stocks and real estate, so on and so forth? I just thought that we would kind of go back and forth to see what Sean and myself do, see where we agree or disagree on some stuff. I know Sean's been around a lot longer than I have, so he's probably seen a lot more of the ups and downs and such. And we're also in two completely different areas. He's basically in the Georgia spot where I'm in Wisconsin, so the real estate side is a little different in each of those areas. So without further ado, we'll basically move on to that. And with that, we just want to say that as an entrepreneur, you definitely want to be investing your money. We've seen a lot of guys over the years make a lot of money real fast, and then 1 or 2 or 3 years later, sometimes even months later, they're almost broke. And we see this time and time again. I mean, I'd say probably at least half, if not more, of the people I know that have made a fair amount of money, probably 3/4 of the people I know that have made a fair amount of money, business side of things, they tend to lose it very quickly because they tend to spend it really fast. And I've always had the viewpoint to live well below your means and invest, a fair amount of extra money to kind of get you a nice little side income and some extra security if there's ever, a low time in business, or if ever anything happens, or even if everything's perfect, just basically gives you additional streams of income. So how I invest my money personally, first and foremost, I look to see first, is there anything that I can invest in personally to increase my own skills or to help with my own businesses? Because that's the stuff that, we obviously understand the most. So if there's anything that, we see that could help in our own businesses, obviously that's a good thing to put some money into, especially if you understand it. But outside of all that, I have a mix of stocks and real estate. And there's a big debate about if you should invest all your extra income in stocks or if it should be moved in real estate. And if it isn't real estate, should you, manage that yourself? Should it be invested in basically REITs and all that? And me personally, I look to invest in real estate where I basically own it outright. I don't do a mortgage. I pay for basically cash. Usually I look for like a multi-unit, not too big, like, a 2 or 3 unit, although I do have a single family one as well as an investment, but I own a handful of multi-units and always looking for more of those. And the general idea that I have in my view is, hey, if the stock market is hit hard or if there's a downturn, at least in the general area that I'm in, there's, lots and lots of job opportunities. There's not like, a single industry that basically props up the entire area. So it's fairly safe if anything goes wrong there. And I look to more so make money from the cash flow of like rents and all that rather than the appreciation. Now, a lot of them have gone up in value a lot, especially in the last couple of years. And I view that as a huge added bonus. The main thing is, again, in my case, I'm looking for the cash flow. On the stock side, I look to invest a steady amount, each and every month, regardless if the stocks are down or if the stocks are up. And I tend to put at least a decent chunk, like approximately half, in like an S&P 500 type, whereas with the other half, I tend to put in stuff that I know a little bit more on, where usually the returns are better, but it's stuff that I understand well. It's basically businesses that I know well, and wouldn't necessarily advise you to just throw a lot of money into a single stock here or there if you didn't know much about it there. But that's a bit about me. About I'd say probably about half to 2/3 of the investments I do are on the real estate side, just because I view that as like a little more steady, at least where I'm from, and the other half is kind of on the stock side, and I'm definitely a much more of a long-term view on the stocks, whereas in real estate it's nice to have the immediate cash flow right there. Now, Sean, I know you've had a lot of money in stocks. You've also had a lot in real estate. I know you also had a lot, in the real estate area, in the crash. So I'd be curious to hear your insight on how you feel about both of those, where you put yours, what you like and dislike about that, and so forth.
Sure. First of all, Brian and I have different viewpoints, in part because Brian is like 20 years younger than me, or more than 20 years younger perhaps than me, and I'm in my 60s. So there's a difference as you get older to the amount of risk that you should or are willing to take. Because it's one thing for me to take on risk in business, is another thing to say, hey, I have all these big retirement funds, let's bet them all on black and hope that, the next spin of the roulette wheel is black and I double my money. Because that's just stupid. That's gambling, and that's not what you want to do with with what your investments. Brian brought up a good point at the beginning that there's a lot of people who make a lot of money and then they spend it all and then they don't have anything. And, that years go by and pretty soon, they were 30 and now they're 40 and then they're 45 and they're 50 and they have nothing saved up for the future. And that's great. If you're like, hey, I've got this business and it's worth $20 million and I'm just going to sell it when I'm ready to retire, that's awesome. That assumes you can keep running the business and really get $20 million for it. But if you can do that, that's amazing, right? But for most people, even if they're running a successful business, that's not the case. Their business isn't going to be worth all that much and you ought to diversify anyway. And the other thing about having diversification before we get there really is I want to mention is just having liquidity. Even if you've got in the stock market and you had to sell out at the wrong time because you need liquidity for your business, for something that happens in your personal life, cash solves a lot of problems. At some point in your business or personal life when it's like the perfect storm. Everything that could go wrong does go wrong, and you just need cash to get through a few months so things get back and get righted around. A good example was when COVID hit. COVID hit a lot of businesses really hard, like restaurant businesses, right? All of a sudden, the place is packed. The next thing you know, it's not packed anymore, and you're hoping you can just get a few takeout orders. What do you do in that case? Well, if you have no reserves, you're in really big trouble. So you want to have some reserves. But when you go to invest, the real question is, what should you invest in that Brian wants me to talk about? And I think it depends upon, your age, the amount of time you want to look at the horizon. Always you need to invest for the long term. You can't just be like, listen, I'm going to put all my money in Tesla stock. Tesla's just going to go straight up because some days it doesn't go straight up. It goes straight down. And so you've got to diversify. You've got to look at the longer term. Tesla might be worth 10 times what it is today in 10 years. I doubt it because it's already grown so much. It can only go so far. They can only take over the world so much with their cars, but it has that ability to grow. And so that's great, but you need to diversify because sometimes you're going to be wrong. Sometimes you're going to be right. The other thing that I want you to understand is that you are, as a human being, going to be the worst possible person to pick investments when things are going wrong, especially. If you look at the studies they've done, and you can read these online, there's tons and tons of studies about how the average person invests. And here's what the average person will do. First of all, they'll sell when the market starts to fall because they get scared. Then the market bounces and it goes up higher than where they sold, and then they buy in. And then they might get some gains, but then the market starts to fall again, so they dump out. And you think, oh, well, they're really smart because they're getting in and out. But the truth is, very few people over the long haul, of course, can time the market and be successful, which means you jump in, you jump out, you lose money. The average person gets nowhere near what the return is on the average mutual fund. If you just bought a mutual fund and held it, you're way better off than trying to figure out how long to hold it, when to sell it, when to buy it. So if the average mutual fund returns, let's say 7%, the average investor maybe makes 5% on mutual funds. And you say, how can that be? Well, here's why. Number one, as investors, we instinctively buy at the wrong time. We don't hold. A lot of people will buy 10 mutual funds and maybe they put $100,000 in each one. At the end of the year, here's what the average person will do. They look at those 10 mutual funds and they say, oh, look, one's up 20%, one's up 2%. So I need to sell the one that's up 2% and buy more of the one that's up 20%. And that's actually the exact wrong thing to do, believe it or not, because the guy that's up 20 beat the market that year by a good margin probably. And the guy that did badly. But if you go look at what happens the following year, the guy that did 20 comes back to the mean. So he regresses to where he would be an average. Let's say his average is normally 10 and he was all of a sudden at 20. Well, he's going to regress to 10 or 8 or 7 because he's going to hit his average. That's what mathematics do. But the guy that was at 2, that guy's going to come back to 10. So what happens is you sell at the wrong time and you buy at the wrong time because you're chasing the returns that are historical, and the history is absolutely no predictor of the future. Go ahead, Brian.
I like what you said about how a lot of people don't hold. They're very impulsive when stuff goes up and down, but that actually reminded me of a story that I want to share of kind of the opposite. I actually knew a guy years ago. He actually ran an investment firm, and he put for him what was a small amount of money into a business that started to take off into their stocks and stuff. And he bought in, I think it was 25 grand. It was somewhere in the low, essentially tens of thousands. I want to say 20 or 25 grand or so. And he kept on seeing it grow and grow and grow and grow and grow. And it was within a matter of months, it went from, essentially 25 grand to $350,000, then to like $1 million, then to a few million. And he actually watched it grow all the way up to around $35 million. And this guy was ecstatic because he's like, holy crap, I just turned basically 25 grand into 35 million. And the entire time he was thinking, I'll just hold. And this could be worth an absolute fortune. And then all of a sudden it went from like 35 million to 30 million, 30 million to 25 million. And then at that point he's like, I just lost essentially 10 mil on that, but I'm going to hold it because I want to get that all back. And it went from basically 20 million to 15, then to 10. And eventually it went down where I forgot the exact amount that he cashed out on, but it was like somewhere in like the low hundreds of thousands. Like he cashed out, I think like 200,000 or 300,000. So still a lot more than like the 25 grand that he put into it. But there's 2 lessons that he said that he learned from that. Was one, if you're basically going for the individual stocks and such, especially the risky ones, don't hold on to those for too long unless you really know what you're doing and pay like a ton of attention. And 2, when stuff starts to go south, always make sure that when you get that super high, sell a portion of that each time. So he was saying, hey, in hindsight, went from basically 25,000 to, like $1 million or so. He wishes he sold like, a fifth of that. And then when it went from that to like 5 or 10 mil, he wishes he sold a fifth of that. So even though the gains wouldn't have been as big initially, he would have had tons and tons of money left over. That's why, I really think the S&P 500 or a lot of other indexes like that can be a lifesaver if you want to be like a super passive investor there, because, you just don't know when a big business will go from like a huge thing to basically nothing. I mean, if you look back, over the decades or even over like 10 years ago, there are a lot of businesses around a decade ago that, we all thought were probably huge that now are either completely out of business or, basically completely unknown. Like look what happened to like Blockbuster. I mean, they lost out big time. That there used to be those all over. Netflix was like a small risky stock at the time that everyone thought, hey, this is going to completely tank, and look, it like, blew up. Whereas basically Amazon used to be like a place that sold books, and that's all that they basically did. And now, they're way different than what they, were then. There's lots of retail stores basically going on business left and right where, you never know in the long run which ones are going to really take off and which ones are going to really tank. But on that note, Sean, I know that you invest some of your funds into real estate, and I know you told me that you kind of regret it now, but I have 2 questions on that. Do you think the crash of basically 2007 or 2008, do you think that affected you like more to kind of leave like a bad taste in your mouth? Or do you think, you just don't want to deal with like the hassles of the management, or you invested essentially too far away? So that's the first question. And the second question, I know with mine, I usually, or I shouldn't say usually, I've always actually bought mine in all cash. I know you've done some with like mortgages and stuff, and I know like you kind of have the thinking like, hey, it's less of your money that you're investing. I want your thoughts on that, on like what you think the pros and cons, and if you could go back in time, do you think you wouldn't invest in that to start with? Do you think you would have invested more? And having said that, do you think you would have done, mortgages then? Do you think you would have done basically cash? Like, what's your thoughts on those 2 things?
Well, I think that, first of all, the real big recession in the late 2000s was an annoyance and really was tough on real estate investors. But that didn't leave a bad taste in my mouth as much as it's just a question of, at the time being in my 40s, that's one thing. And, being in my 60s, it's a whole nother thing as to what I want to deal with and have to clean up at some point when I go to sell. I never managed real estate myself. I've always had third parties managing it, which adds to the expense of having the property, but means that I never have to meet the tenants, talk to the tenants, deal with the tenants, fix the problem, and, get any complaint or after hours calls or anything like that. So that part of it's been relatively easy, but I think that it's just a question of, as I get older, my business investments and the things that I'm doing have enough moving parts, then I really don't want too many other ones that I've got to deal with. And if I predeceased my wife, then she's going to have to deal with a bunch of stuff that she doesn't want to deal with. So that would be my only reason for saying, real estate's not good. We've made a lot of money in real estate. We've had deals that are better than others, that's for sure. And in some cases, we've paid cash for properties, especially in the last couple of years, because it was the fastest way to get deals done. When we wanted to buy something and the pandemic had hit 2 years ago, and then all of a sudden you could go into a house and buy a house, it clearly was just going to be like the floodgates opening and a race to see who could make the deal the fastest. And one of the advantages that we had over people that had to get a mortgage, even if they were pre-approved, was the fact that we could just write a check and buy the house and close as fast as the seller wanted to close. And in some cases, that was the way that we got the deal done. But on the other hand, money, it's more expensive than it was, but it's still cheap. Historically, you look at one point from the 70s into the 80s, mortgage interest rates were well above 10%. When I got out of law school in 1985, started working and doing real estate closings and worked at a title insurance company doing, real estate closings. People were super excited because interest rates had just gotten below 10%. Now, many of you are out there with like 2.5% loans. But you can't imagine what the difference is, if you were above 10 and you're going from 12 or 13 down to like 9.5 or 9.75, that's pretty awesome. And they've continued to gradually fall ever since until we hit, rock bottom the last, 3 or 4 years, right? And so that money is cheap, but it's only cheap if you're going to do something worthwhile with it. Like anything that you go and borrow money, you've got to know what you're going to do if you borrow the money. And if you're going to buy real estate and have negative cash flow because you've got a mortgage on it, and every dime you have is in that piece of real estate, then you're right back where I talked about before with your business, where if you have no money and something goes wrong, that's a bad place to be. The real estate over time is going to go up in value unless you're just incredibly unlucky. It's going to ebb and flow. Things are going to go down at some point, but are they going to drop by half? Are they going to drop by a third? Who knows, right? Everybody's got a prediction, and I'm not going to make a prediction because I don't have any idea. But I know that in 10 years or 20 years, you're going to hit a point where what you own is going to be worth a lot more than it is today, because historically that's always going to be true. The one thing I would advise is just never chasing. We looked to buy a property because it's right next to another property we own. I'm trying to remember what it was. Sometime earlier this year anyway. And we were the first people in to see the property. We offered them exactly what they're asking for: cash, flexible closing. All we needed was to do an inspection just to make sure that there was nothing disastrously wrong with their house. Didn't appear to be really well maintained. And they ended up selling it for like $78,000 more than the asking price. It was a lot. It was more than 10%. Yeah, at least more than 10%, 15% maybe higher than the asking price. And we weren't going to go and chase it and get into a bidding war because it was not worth it. It's not like we needed to live in it or anything else. We just wanted to buy it as an investment. And so we didn't chase the deal. And there are a lot of people who have chased deals over the last year, and that's going to take some of them some time to get out of those deals financially to get the properties back up where they were, because obviously you hit some point where the market is going to correct itself. Again, I'm not saying that the market's going to go where your $500,000 house is worth $200,000 overnight, but it's got to soften because it just can't keep going gangbusters forever. And a lot of people were pushing to get moved because they knew interest rates were going to go up, or certainly felt that way. And there were a lot of factors why, everybody was trying to do that. So, in the long run, if you've paid cash, you're going to be in great shape. If you could go borrow money against that anytime you wanted to and get the money, even in a bad market, you could go pull cash out of there pretty quickly if you wanted to. If you've got several properties, you could go to a bank and arrange a line of credit that's secured by those properties and pay a small amount of fees to have the ability to write a check and borrow that money whenever you wanted to. So you have a lot of flexibility, and it's getting to that point of having flexibility that I think is really, really important. I grew up real like average middle class bringing up, right? My dad was an IBM programmer. My mother was a registered nurse. My wife, on the other hand, grew up poor. Her dad was sick an awful lot, had a series of heart attacks, died right after her 12th birthday. Her mother didn't work, didn't have a driver's license, didn't have a car. They relied on her older brother to be able to get around. So, they lived off of, the Social Security checks that her mom got till she got through high school and she could go out and go to work. And my wife really brings up an interesting point that money gives you choices. And it's just simply that if you have no money, there are no choices. When you have money, you can have choices. And you want to make sure once you have it that you continue to have it and have those choices. I think it's really important that everybody's going to be able to historically look back and say, oh, I should have bought Bitcoin when it was $1. Yeah, no kidding, right? And maybe you did. And maybe you bought 1,000 and you held it all the way through all the ups and downs. And, you've got, $1 billion in your pocket now. But very few people will have done those kind of things ever. And if you chase anything, real estate, stocks, crypto, with all your money, and you bet it all, you're probably going to lose in the long run. Whereas if you take your time and then you diversify and you invest and you pay attention, you're going to do better. I also think if you're going to be running a business and you're running a successful business, that takes a lot of your time. And if you don't know anything about investing and you don't want to take the time to learn, then you need to go get a financial planner, a certified financial planner that you feel comfortable with, and talk to them. And they work in different ways. There's fee-based ones where you just pay them a fee. They earn nothing off of whatever you invest in. And there are other ones that you can pay a small percentage to manage the whole thing and do all your thinking for you, although they won't make changes without consulting with you. But I think that having somebody smarter than you, and if you go talk to financial planners, and you will talk to some of them, you'll be like, this person is like as dumb as a box of rocks, I don't think they're smarter than me. Then you don't use them. Just because they have a certification doesn't make them smarter than you or better at investing necessarily. But I don't think you can sit around and just, randomly pluck stocks from the air and, somebody on Facebook said this, and so therefore that's why you're going to invest. Because in the long run, you're just going to get killed. Like Brian said, smart, rich guys make huge mistakes, right? If a third-party money manager had invested $25,000 and let something run to $30 million and never sold before it comes all the way back down, you'd probably be firing them, trying to sue them for mismanagement, right? I mean, you'd be like, that's really stupid. So if really smart guys with lots of money who could afford to sit there and watch something go to $35 million or $30 million and not think, hey, I really should just sell that because this is a huge windfall and, that's more money than I could spend in the rest of my life, then just imagine the screw-ups that you can make if you're not going to pay attention. So, Brian, we probably should just recap this. I know we've gone on for a long time, but it's really important because you said from the beginning, there are guys that we know that have made a lot of money and they spend it all. And they go out and, buy lots of expensive toys that they usually finance. And then they've got big payments and all of a sudden they've got cash flow problems and they have a real mess instead of creating a secure future for themselves and their families. And I think it's super important that they do that and be intelligent about all of this.
I really like the point that you made about don't go essentially chasing those deals and such. Because I've seen that, it's much, much better now. But 3 or 4 months back in the real estate area, I actually put in 4 or 5 offers on some properties around here. Everyone was getting rejected, and I had some that were well over the asking price. Some had no actual contingencies or anything, and it was ridiculous. There'd be 14, 15 other offers, and there's stuff that would go sometimes, as high as a fourth above the asking price. It was absolutely nuts. Whereas the numbers just didn't make sense as an investor. And there's some of the properties we saw were hey, this looks really, really nice. We really like the location. We like the units. We think rents could go up in time, but it's it just didn't make sense to way overpay. Whereas now it seems prices are starting to not necessarily come down a lot, but houses are starting to stay on the market a bit more. You can get, a handful of deals. And if we would have chased all those around, we would have overspent, we would have missed out future opportunities, some stuff now. So I think that's a great point there. So yeah, to recap everything, again, first, if you're an entrepreneur, first and foremost, I think you need to be investing in yourself and in your business and stuff that and really, really understand well, because you'll probably get the most maximum returns out of that. But having said that, when you do make a fair amount of profits or even a small amount, you want to make sure to start investing that either into stocks or real estate or something, or a mix of both, because I've seen way too many people do neither of those. I think if you have enough funds, you want to kind of diversify a bit and maybe do a mix of both those. But again, don't let it necessarily distract you from your main business. So, if you go the stock route, you shouldn't be monitoring the stocks every day. You know, you want to throw some stuff maybe into like an index fund that you don't really have to monitor much, or on the real estate side, don't necessarily get like, you know, a 50 unit building that you basically manage yourself and it's like a full-time job. I mean, that will completely distract you from your main essential business there. So with that, make sure to watch our next video where we'll actually talk about how we would invest in two different cases. If you're starting with $5,000 or if you're starting with like $1 million extra, we'll kind of go through that. And if you like this video or you want to hear a bunch of other topics about how we invest as entrepreneurs or how we grow our businesses, how you can make more, make sure to like and subscribe. And we greatly appreciate that. So with you, we'll see you guys on the next video. Thanks.